Hi, thanks for joining us. Today, we are going over Financial Symmetry's third quarter of 2022 market update. I'm Grace Cavantis.
And I'm Mike Eklund.
And we make these updates once per quarter, so about 4 times per year. And we're looking forward to going through some hot market topics with you today. And those are going to include things like what's going on with bonds, why are they down? Should I own international investments and why? And will the upcoming election affect my investments? Should I make any changes? So with that, we have a quick disclaimer that this is for informational purposes only and does not constitute investment advice or legal advice. So with that, Mike, can you get us started off by explaining what's been happening in the equity market so far this year?
Yes, thank you, Grace. Yeah, it's been a very challenging year for all investors this year in terms of the equity markets, not only US stocks, but also international stocks. It's really down somewhere between 20 to 25% for the year. And as this slide shows, is that since 1979, so over the last 40 years, this is the second worst start to the year. So just think about that. Last over 40 years, this is the second worst start we've had. I think the worst was 2002, but it's been challenging. I'm sure many folks listening today have seen their account statements or been watching the news and been concerned about their portfolio values. Hopefully we can talk a little bit about why this has happened before in terms of market declines and why we feel confident that things will turn around like it has in the past. So some of the questions of why it's gone down so much so far this year, things such as obviously there's concerns over inflation. The Fed has been raising interest rates, obviously the news overseas with the war in Ukraine, and then obviously the talk of, will we enter a recession this year or next? And so that's those factors are, moving the markets down, but just as quickly as they go down, they can move back up as well. So just moving forward to the next slide is just a little bit of a background. I know that it's good to kind of not only provide what happened so far this year, but also look at back history. And since 1926, we've had 17 bear markets, and that's when we've had a stock market decline of 20% or more. The only thing consistent with those 17 bear markets is all 17 were temporary. And as you can see here, some of those bear markets lasted for 20 months, 6 months, 27 months, but they were all started again a bull market. And those bull markets typically were pretty strong and lasted a lot longer. So I always like to say the fee you pay for higher stock returns as you have to deal with these declines, which are normal. And so they typically happen about every 5 years. And so for someone investing for the next 30 years, you can expect at least 5 to 6 additional bear markets like we've seen this year. So Grace, what do you think about what happens to your risk of investing in the stock market over time?
Great question. I'd love to tell you. The longer you're invested in stocks, the greater the chance that you're better off at the end of that time period. And so this fun chart shows us historically, going way far back in the research, we can see that in general, that middle column, if you've owned a well-diversified equity portfolio for 5 years, about 90% of the time, you were better off at the end of that than you were when you started. But even more encouraging to me is that 20-year, 100% of the time, if you held a portfolio for 20 years, 100% of the time at the end of that, you were better off than you were when you started. So time is the great healer when it comes to owning companies or stocks. And the longer you own them, the less risky they become. So yeah, I love this chart to be reminded of that because balances in the accounts don't look so great right now.
No, when everyone focuses on the left side here, the monthly or how they're doing so far this year, when the reality, if you look out the last 5, 10, or 20 years, you probably have pretty good returns in your portfolio. It just everyone seems to focus on the short term and not the long term. But this is a good slide when we get to a future slide, a little bit more about our Financial Symmetry's investment strategy, why we create the strategy that we do takes a big factor of this way this slide impacts that.
Absolutely. So Mike, how have bonds done this year?
Yeah, that's been the challenging part because I think a lot of folks have typically seen over the last, recent bear markets like 2020, the global financial crisis, the tech bubble, when stocks have done poorly, bonds have typically done done well. So they've kind of felt like they had that ballast in their portfolio. Unfortunately, bonds are off to their worst start of the year since 1976. So over the last 45 years, we haven't seen a worse year in terms of the bond portfolio. And it's not even close, as you see by the lighter colored line here versus the gray lines. The U.S. bond market index has been down much greater than we've seen historically. So it's been a challenging year. Although the good news, which we'll get to here on the next slide on these declines, is that based upon the current yields, from the beginning of the year, you were getting paid probably 1% to 2% to investing in bonds on the good side. Now that yield or that interest rate you're getting to investing in bonds is between 4% to 5%. So what that means is your future returns should be much higher now because of the higher yield than you would have had if interest rates stayed at 1%. So this slide is trying to illustrate that, and that the lighter colored teal line is where the situation we're in today, scenario 2, where we saw a drop in prices of about 15% for those that own the U.S. Total U.S. bond market index. But over time, because of that, now they have that higher interest rates, about 4% going forward or a little higher. The long-term value over 10 years is much higher than the darker blue line, which is the scenario we were at the beginning of the year, where interest rates were closer to 1%. So we've had to deal with some pain in the short term, but in the long term, we think folks will be much better off. And then once again, for financial symmetry clients, this assumes that the client's bond duration, which is similar to maturity as it is at about 5 years. For financial symmetry clients, their duration or maturity is somewhere between 3 to 4 years. So the break even should be much closer. And we don't only own the bond market index, we also have short-term bonds and money market that have done much better than the 15% decline so far this year. So
it's good to hear.
Yes, overall, there is some positive. There's some silver lining among the recent decline in the bond market prices.
Excellent. With that, we want to explain a little bit about financial symmetry's 3-step investment process. So this is for if you're a financial symmetry client. Some of this is going to sound familiar, so it's what we do for you. We start all of our clients off with a financial plan, and that helps us develop their investment plan. So we look at when you're going to need the money you're saving. And if it's in the short term, we have a strategy for that. If it's longer term, we have a strategy for that. Mike, do you mind explaining?
No, that's a great point. I think it's, as the slide we showed earlier, in the short term, stocks are risky in terms of, in a yearly basis, 1 out of 4 years, the market is down. So we don't want to take the risk of the stock market for money you need the next 5 to 7 years. But for money you don't need the next 5 to 7 years, your biggest risk is things like inflation, healthcare costs, college costs for the kids. And so we need that money to grow. So the best investment for that long-term growth is owning companies or stocks. They have historically exceeded inflation about 3 times a year over the long term. And so that's why we invest for your long-term growth, and bonds for short-term cash needs.
Yes. So then we take that and we implement the investment plan. How's that work, Mike?
Yeah, well, this is where we utilize the combination of mutual funds and ETFs, low cost, tax efficient, globally diversified. I think our typical portfolio includes close to 10,000 companies globally, US and internationally. And then, not to go into too much detail today, but we then tilt those holdings towards areas of the market with higher expected returns. And that's based on the evidence-based investing approach we use. So ask your advisor if you have more questions on that part, but that is an important part as well as our process.
It is. And then I think one of the most important parts is the 3rd step, monitoring the investments, which I think also might be the hardest to do ongoing. So what's that look like?
Yeah, this is the one part where I think people on their own kind of miss or they forget to implement. But that's really, the first one, opportunistic rebalancing. A perfect example of that is March of 2020. The stock market went down really fast. Our systems alert us that, hey, when the market goes down a lot, it's time to buy. And when the market goes down really high, goes up really high, then it may be time to sell. So we call it opportunistic rebalancing, is that we're not changing your mix of stocks and bonds at a set date during the year. We're doing it based upon market conditions and when things warrant a change. And then also, as your situation changes, as you get closer to retirement or paying for the kids' college or putting a down payment on a house, your allocation to stocks can change your portfolio as well. So we look at that on a regular basis to adjust too.
Correct.
Well, good. Well, this is, if those who listen to previous webinars, this is a slide we've shown before, so I'll be kind of quick here, but the summary of this is historically, when the market declines, as we see right here, we're in about the 20% market decline situation, future returns have looked good. So on average, the 1-year return after that is about 22%, the 3 years about 41%, and the 5 years about 72%. So even though people get concerned when the market goes down, it's usually a better time to invest. And so this graph reflects that as well.
I really can't wait to see those returns.
Exactly.
If we see those returns, but
I'm sure many on the
past.
listening as well. But the next one relates to the international markets. And this is one where I think we've heard a lot of negative news from clients saying, why do I own anything but, US stocks? US stocks have done so well the last 10 years. And that's correct. I mean, US stocks have been the best place to invest over the last 10 years. But the reality is that's not always the case. You look at, for example, the 2000s here, the orange line is the performance of international stocks minus US stocks. So pretty much during almost all the 2000s, the international stocks outperformed US stocks. Also in the 80s, international stocks outperformed US stocks. But there are time periods like the 90s and the 2010s where US stocks look better. But as you see, they do kind of go up and down. And so that's what we believe in a globally diversified portfolio versus putting all your eggs in one basket, which I mean just investing in US stocks or just international stocks.
We sure do. And along those lines, on the next slide, it shows us the returns of US stocks versus international, developed or emerging. So it looks at the decade from 2002 to 2011, and then the subsequent decade from 2012 to 2021. And so you can see the differences. In one, US outperformed a ton. So that was the more recent decade in the middle there. But compare that to the one prior, it underperformed. And so when we look at that third section that has returns that are all right around in the same area, we see that over the 20-year time period, the returns were all very similar. So even though recently, the past 10, 12 years, US has been killing it, and it feels like, why didn't we have all of our money invested only in US stocks? We can look historically and see that that's not always the best strategy. And so that's, again, why we recommend a globally diversified portfolio.
Yeah, I mean, I think a lot of people are pretty shocked when they see this, to see that over the last 20 years that emerging markets and US stocks have the same returns. I think if you ask, majority of people would say that's not even close, but that's the problem with recency bias. Most people assume that what's done well lately will do well in the future, when that's not always the case.
That's true. Well, another question we've been getting a lot from clients is, should we change our portfolios because there's an election coming up? And so we wanted to add a slide and chat about that briefly. And so you can see here different time periods and different colors, and that's showing who was in Congress. So was it a Republican or Democrat majority or mixed? And the theme that you see here is that it continues going up long term, regardless of who's in office. So as we have a midterm election coming up, we are not changing our strategy. We don't recommend you do either, because stocks have trended higher no matter who's got control of Congress. And so that's not something we need to be fearful of.
No, that's a great point, Grace. And it's really important that you don't let your political views impact your investment plan, because we've seen too many times where that's made a big impact to your long-term financial situation.
Mm-hmm.
So finally, to wrap up, just to summarize, if you want more information on our investment strategy or overall wealth management approach with our clients, feel free to check out our website at financialsymmetry.com. If you're an existing client, you can contact your advisor to ask questions about your existing portfolio, as well as obviously access to our previous webinars, podcasts, and blog posts. And then finally, if you are not a client but want to learn more, there is a Talk to an Advisor form on our website where you can fill it out, and will be contacted by a certified financial planner and about how we can help your personal situation. So finalized with that is our contact information for Grace and myself. Feel free to reach out if you have any questions on the slides or your overall investment approach. And we look forward to speaking to you in 3 months.